Hi, this is Phil Yaeger of Yaeger CPA Review, and today I'm going to cover with you installment sales from a tax standpoint. And I'm going to cover it under makers and acres. Now, makers is dealing with property placed in service after 1987. Acres deals with property placed in service before 1987. So, let's start off with a makers example. Now, with makers, let's assume we have a Section 1231 asset, which is personal property used in a trade or business which is held for more than 12 months. And let's assume that we sell this property, but we sell it under the installment sales method. Now, here's the facts. The selling price is $100,000. Now, our cost is $30,000. Our depreciation taken is $10,000, giving us a basis of $20,000, giving us a gain of $80,000. Now, when you are selling any type of Section 1231 asset, personal property used in a trade or business, under the installment sales method, the first thing you have to remember that, all right, calculate the gain, all right, all the depreciation, which would normally be recaptured as ordinary income, has to be recognized in the year of the sale. So, the first thing is, all right, the depreciation taken is $10,000. If this was just a plain sale, then $10,000 of the gain would be ordinary income. So, we have ordinary income of $10,000, and this is under Section 1245. Now, the next thing you have to do is, now you have to change your gross profit percentage or your basis. So now, whatever ordinary income we recaptured, all right, we have to now add it to our basis. Now, our basis before was $20,000, so now our basis is going to be $30,000. And our gain is going to be $70,000. So, now we use the installment sales formula. And what is the installment sales formula? It is our gross profit over our contract price times the amount realized. Now, how much are we going to realize? Well, all right, we sold it for $100,000. We're going to get $20,000 a year in principal for 5 years. So let's get our gross profit. Our gross profit is what? 100,000 minus 30, 70,000. We divide this by our contract price. Contract price is defined as the selling price minus any debt assumed by the buyer. Well, there's no debt assumed by a buyer, so the contract price would be the selling price of $100,000. So notice now, our gross profit percentage is 70%. Now we take our 70% times the amount received, which is $20,000. So the total gain that we're going to recognize this year is $14,000. Now, remember, the first portion of the gain is going to be whatever we recapture. When we sell a Section 1231 asset, personal property used in a trade or business, whatever depreciation you took, that's going to be recaptured as ordinary income. So, we already figured that was $10,000. And then we increased our basis and made our basis from what? 20 to 30. And then we calculated the actual recognized gain for the year. Now, our recognized gain is $14,000, which means that we have another $4,000 of gain to account for. And that would be Section 1231, which would be a long-term cap gain. So, what did you learn from this? Well, you learned this. First of all, whatever you have to recapture as ordinary income is all captured in the first year. Then you add that recapture amount to your basis, and in this case, it increased our basis, which did what? Decreased our gain, and now we have to calculate the amount that we actually realized from the gross profit percentage formula for installment sales. That was $14,000. We subtract that from the total amount we recaptured, and the balance of the gain is Section 1231 gain. Now, if you receive any interest income, remember, all the interest income that you received is picked up in the year received. You don't apply any installment sales method to interest income. Now, let's take a situation under acres. Now, let's assume we have real estate used in a trade of business under acres, and it's held for more than 12 months. Well, acres, remember, you can take accelerated depreciation for real estate. Now, the IRS, however, wanted you to take straight line depreciation. So if you took accelerated depreciation, you have to go back and recompute what your depreciation would have been on the straight line, and this is called excess depreciation. And this is the amount you have to recapture as ordinary income under Section 1250. All right, so let's take an example of that. First of all, selling price of this real estate, this building, is $100,000. Now, please remember, our cost was $30,000, and our depreciation taken was $10,000, giving me a basis of $20,000, which I had a gain of $80,000. Now, let's assume the excess depreciation taken was, all right, $12,000. Well, immediately, that $12,000 is going to be recaptured as ordinary income. Did I say 12,000? 12,000. The excess depreciation will be recaptured as ordinary income under Section 1250. But whatever you recapture, that will increase your basis. So now my new basis is $32,000. And I have a gain of $68,000. Now, let's calculate our total gain under the installment sales method. All right, we take our gross profit and divide it by our contract price. And remember, each year we're going to receive $20,000 for 5 years. So that will be $20,000. Now, our gross profit, all right, is what? $68,000. And our contract price is $100,000. So our gross profit percentage is 68%. 68% times 20,000. Let me calculate that for you. All right, 0.68 times 20,000 will give you $13,600. So the total gain is $13,600. All right, we recaptured 12. The difference is $1,600. The $1,600 is going to be Section 1231 gain, which is long-term capital gain. So anyway, in your Wiley books, if you have it, just read the section on installment sales and go beyond it and read the remaining information. And it talks about what happens if you have any type of ordinary income that you have to recapture and how you treat it for installment sales method. I hope this gives you some idea, and once again, good luck on the exam.